Welcome to my new video. My name is Mauro Ferrari.
The distinction about neutral patterns is that price can be going up or down before the pattern, and it can go up or down after the pattern. So the key thing to look for is the direction that price breaks out of the pattern. Where price was going before the pattern doesn't seem to be that important when we are talking about neutral patterns. The neutral patterns are composed by 4 types of triangles. Let's begin by the ascending and descending triangles first. The ascending triangle, as we saw earlier, can be either a bullish continuation pattern, meaning that price will be going up, and then the ascending triangle will confirm a continuation to the upside, or the ascending triangle can be a neutral pattern. That means that the direction the market was going before the pattern is irrelevant. What matters is the breakout direction that confirms the ascending triangle. If price breaks the upper line of the ascending triangle, it means that price is probably going to the upside. If it breaks the lower line of the triangle, it means that it is probably going to the downside. The way to trade either direction is the same as all other chart patterns we saw. We wait for a breakout and then wait for price to retrace to the breakout line or neckline. In the case that price breaks out to the upside, the stop should be below a confirmed demand zone and the target should be at least 3 times as the stop size. In the case that price breaks the pattern to the downside, the stop should be above the upper horizontal line and the target should be at least 3 times as big as the stop. In the case of a descending triangle, we have the exact same situation. The only difference is that the upper line of the triangle is downsloping and the lower line of the triangle is horizontal. Once again, since this is a neutral pattern, the trader must pay attention to where price breaks the pattern. If it breaks it to the upside, the stop should be below the lower horizontal line with a target at least 3 times as big. If price breaks the pattern to the downside, the stop should be above a confirmed supply zone with a target at least 3 times as big. Following the exact same rationale once again, we have 2 other types of triangles that finish the category of neutral chart patterns. We have the symmetrical contracting triangle and the symmetrical expanding triangle. The only thing that changes between these neutral triangle patterns is the angle of the upper and lower lines. Beginning with the symmetrical contracting triangle, we have upper and lower lines that converge to each other, so this pattern implies a decrease in volatility. If price breaks to the upside, the stop should be below the lowest low in the triangle or in a confirmed demand zone. And if price breaks to the downside, the stop should be above the highest high in the triangle or in a confirmed supply zone. The target should always be at least 3 times as big as the stop if you want to use this consistently in the long term. The next triangle is called symmetrical expanding triangle. This one implies an increase in volatility that can be quite challenging to trade. If price breaks out of the pattern to the upside, the stop should be below the lowest low in the pattern or below a confirmed demand zone. If price breaks the pattern to the downside, the stop should be above the highest high in the pattern or above a confirmed supply zone. The target in all situations should be at least 3 times as big as the stop. This finishes off the exposition of the most relevant chart patterns for trading.
If you liked the video, please subscribe to my channel.